There's been a relentless rise in US government federal debt. Same, of course, in Canada. But sticking with the US, our guest says the level is poised to rise to 115% of GDP over the next decade. Just yesterday, the Federal Reserve Bank of New York published a report indicating that credit card debt is at an all-time high, over $1 trillion US. And of course, the US government is once again preparing for a possible shutdown in a week's time. Let's bring in Robert Sockin, global economist at Citi. Robert, thanks very much for coming on the show.
Thank you.
You have a fascinating report out there. I mean, can we cut to the quick? What are the risks that the US government debt gets so high that there is a loss of confidence in US treasuries?
Yeah, it's a great question. Thanks so much for having me. Just to start off, to give some numbers, as you said, by reasonable estimates, the federal debt's going to rise from about 100% of GDP. That's close to the highest level it's been in history. The highest was World War II, around 106%. And over the next 10 years is likely to rise to 115%. And we think the risks to that number are to even higher deficits and higher debt levels. So the numbers are very large. And you're seeing that kind of getting digested in the market about how much debt is too much. The bottom line from our study is we really don't have a great way of identifying pain thresholds or just what level of debt to GDP is too much for a country, particularly like the US, to sustain. But you're clearly seeing markets think about that now. And if you were to have a crisis type of scenario, we think a template might be something like we saw in the UK last year during the gilt crisis, but much more sustained, where you saw risky assets sell off sharply, economic sentiment fall off. And if it were sustained, probably a material hit, not just to US growth, but to global growth as well.
Robert, what do you think the response of the Federal Reserve might be in that sort of scenario? I mean, they expanded their balance sheet massively in the period after the great financial crisis. Is that a backstop that's available to the U.S. that isn't necessarily available to other countries that have a lower standing globally?
Yeah, that's a great question. And I think, again, looking at how the BOE responded during the gilt crisis, even though they had just said that they were going to be running off their balance sheet, they basically had to step in and kind of reverse course in order to support markets and financial stability. So we think in a crisis type of scenario, the Fed's going to be in a very difficult spot because, of course, it's going to look like if you have a treasury crisis that the Fed is monetizing or bailing out the government in some way. But on balance, we think that their commitment to financial stability will win out, and they probably have to step into the market to quell fears, as we saw in the UK crisis. I should note, though, that this is just a risk scenario, and we put the lowest probability on an outright crisis type of scenario in the U.S. The U.S. has a lot of benefits that other countries don't, as you alluded to. The world's largest economy, deep and liquid capital markets, the world's reserve currency. So in our base case, we think these fears in the treasury market about large supply mostly calm down, and we go back to the pre-COVID configuration, which was government debt in the U.S. and other large developed markets did not seem to have a big effect on government yields, that there was very low cost to the debt. So we think base case, that's the scenario you go back to. But we also think that these numbers are getting very large, and it's best not to push the debt much higher from current levels.
And yet that is happening and looks like it will continue to. So we look at U.S. debt at this point and say, all right, we can earn 4.6% on a 10-year bond. Inflation's at 3.7% and hopefully falling. There's a real yield there for investors for the first time in a while. That is great for investors. It's not so great for an issuer. How do you see that playing into the trajectory of the government spending and the government budget process over the next couple of years?
Yeah, and that's a great point. And if you look, we have some figures in the paper. You're going to see debt service cost for the government rise very significantly as a share of both the government's revenue and of GDP, given these high debt levels. and higher interest rates. I think the risk is that those high debt service costs start to crowd out other forms of government spending, because we have to give so much of that revenue that's coming in towards interest rates. Or, again, if we're not in a crisis type of scenario, it may be that it just leads to even larger deficits and the pie gets even bigger. And I think that, again, highlights the risk that we note in this report, is when you look at these numbers, deficits are set to average close to 6% of GDP over the next decade. That compares with 3.5% of GDP pre-COVID. And when you start adding up all the factors, like increased interest costs, but also the potential for further climate measures, which some people think will cost much more than is currently baked in by the Congressional Budget Office's estimates, it's very easy to get to even bigger numbers here. So I think that interest cost story just highlights the risks that the debt could get even larger than we think. And at some point, again, might become constraining. We're not at that point yet for the government. As you said, there's no seemingly end in sight for spending. There's not a lot of talk of deep fiscal restraint, but we may get to that point.